It could be a number of different things. The player, of course, is your name. The auditor, the person who sits to your right, which is basically making sure that you're being honest about what you put on the personal financial statement here. And then the game starts out by giving you what your salary is, which is kind of in line with whatever your profession is, what your expenses are, kids, things like that. And so you have on the top half the income statement. That's the month to month what happens. And as you go around the board, you have to pay your expenses and then do things to earn income. But one of the things that's very, very important, very subtle though, is if you look under the auditor, it says passive income. So there's your regular income on the left, and then there's all of the expenses, and that's whether you have a positive cash flow or not. But passive income, the way to win the game is to have more passive income than expenses. Okay. And it doesn't matter what your expenses are, and that's up to you to control those in life. But the name of the game to be financially free is to have more passive income than expenses. And I'm going to tell you that for me, this is probably the third or fourth time that I've read this book. This is what's standing out to me this time. And I've gone so far as to now I have 3 columns when I add up my income and track my income. And it's active income. That's trading hours for dollars, whether it's commission based, whether it's hourly wages or salary. It's all active, because as long as you are actively involved, that income happens, commission, hourly, and salary. If you stop that activity, the income also stops. So it relies on you trading your hours for dollars. Then there's the semi-active income, which is, for example, you build a team in an organization, you open an agency, whether it be real estate or insurance, and you hire a bunch of agents, and now you leverage. So this is the semi-active is when you start to leverage. And on the left column, which is active, there's no leverage. Then there's a little bit of leverage or some leverage, and to some extent, good leverage, the bigger you build your team. But again, if you stop, then either that income slows down and may even diminish as, as the other people, and that's the key, the other people begin to either lose leadership, lose guidance, lose interest. And you'll notice that if a broker at a real estate company were to not show up for 6 months, when he comes back, there may not be a real estate agency. There may be if someone fills the shoes. But the third column, which is this one, the passive income, and that's income that doesn't rely on other people, and it doesn't rely, going in and getting the income, and it doesn't rely on other people to do something. So for example, your investments, the dividends, interest income, rent income, and so forth. And so now, I'm going to give a lot of credit to this book, and also to a book that me and some partners just wrote called A 5-Year Career, where the name of the game, and we could all do this. And I could have done this a lot earlier if I'd understood the difference between active, passive, and semi-active, because the name of the game now is, what if, and ask this question at the end of the month, if I didn't have active or semi-active income, what level is my lifestyle now? Right? In other words, how much passive income comes in, could you live on that? And if the answer is no, got to keep building it, got to keep building it. If it's not at the level you want, right? Because the expenses are up to you. The income is also up to you. And so that's why this thing is so valuable. And I tell people the following statement, and I believe it to be absolutely true. If you're not filling out this simple 1-page personal financial statement, somebody else is filling it out for you. Okay. And when they fill it out, who do you think they're going to slant the advantage to? Right? I'll give you a perfectly clear example. When you apply for a mortgage, I can't remember the number of people. I mean, I could count it on maybe one hand over the years that people who, when they came to apply for a mortgage, said that they had a personal financial statement printed and ready to go. Because I could just copy the information onto the application and we could get that done. Instead, a mortgage broker has to take an application. I've got to ask you, what's your salary? What's your W-2 income? Do you have any part-time income? Do you have any other income? And I'm filling out the income statement with whatever they can verify. That's also important. And so in a lot of cases, people think and here's another thing that's happened over and over, so many times that I can't count. How much do you make? I make 100,000. Okay, so then we start going down and I go, okay, I'm at 7. Where's the other 3? Right? And it's because something happened one month and they had a really good month and they remember that. Or even more common is that they have $10,000 worth of income and $9,000 worth of expenses, right? So now they're earning, they have $1,000 of disposable income, or in many cases, $0 in income. So anyway, I could go on with stories about that, but this one upper right-hand corner box, passive income, is a game changer once you understand it. And what it really does is it gives you extreme clarity as to where you are. Because I have a question, and where did I put it? I had it here. It's a question that I frequently ask people almost every day. And basically, well, I know it by heart. And it basically is, are you completely comfortable that your retirement is taken care of? And people look at me like, no, not really. And the natural question is why, and do you have a plan? But the number of people who can absolutely with confidence say, I'm good, I could retire right now, is very, very few. And that's why, the 80-20 rule is alive and well. 80% of Americans retire financially dependent. And then here's the very interesting thing about the 80-20 rule. It applies to everything, right? So you have the 80-20, the 20% that retire financially okay, right? Maybe financially independent. But then if you were to take the 80% or the top 20% of the top 20%, you're at the top 4%, which are the wealthy, right? And then if you were to take the 20% of the top 20% of there, you hear about the infamous 1% out there that are very, very wealthy. And I'm telling you today, most of those people are in the hundreds of millions of dollars in net worth. The change and the disparity has changed a lot. Anyway, I focused a little bit, and the balance sheet, of course, is what you own versus what you owe. And then that's how you calculate your net worth. But look at this. This is a simple one-page form. It's part of the game. But if you were to play the game with your real life, in other words, use this as a habit and fill that form out once a month, it's like getting a report card in school. You're going to know whether you're going to pass or fail when it comes time to get that last paycheck and see what residual or passive income you're going to live on. And most people, the answer to that is, well, it depends on what I get from Social Security. And that, my friends, is no financial plan at all. So here we go. We're on page, let's see here, just to get everybody who has a physical book. We're on page 239. That's 839 is where we're starting here. Chapter 12, step 2 of the 7 steps that the book is recommending. So step 2 is take control of your cash flow. People who cannot control their cash flow work for those who can. Many people believe that simply making more money will solve their money problems, but in most cases, it only causes bigger ones. The primary reason most people have money problems is that they never schooled in the science of cash flow management. They were taught how to read, write, drive cars, and swim, but not how to manage their cash flow. By the way, footnote, that's a shame. And it's a shame our schools aren't doing that from the elementary level. Without this training, they wind up having money problems and then work harder with the belief that more money will solve the problem. As my rich dad often said, more money will not solve the problem if cash flow management is the problem. After your commitment to mind your own business, the next step as CEO of the business of your life is to take control of your cash flow. If you do not, making more money will not make you richer. In fact, more money makes most people poorer because they often increase their spending and get deeper into debt every time they get a pay raise. So true. And that's where you hear the expression, which I love, which is he's he makes six figures. He's just broke at a higher level. The majority of people do not prepare personal financial statements. At most, they try to balance their checkbooks each month. So congratulate yourself because you're already ahead of most of your colleagues simply by completing your financial statement and setting goals for yourself. As CEO of your life, you can learn to be smarter than most people, even your banker. Most people believe that keeping two sets of books is illegal, and that is true in some cases. But if you truly understand the world of finances, there must always be two sets of books. Once you realize this, you will be as smart and maybe smarter than your banker. As CEO of your life, always remember these simple words and diagrams from my rich dad, who often said, for every liability you have, you are somebody else's asset. Boom. The following is an example of two sets of books, yours and your banker's. Your balance sheet, like for example, your house, the mortgage is a liability, i.e., you owe someone a certain amount of money, whatever the amount that you borrowed. To the bank's balance sheet, that's an asset. They had the money, they lent it to you, so they still have the equivalent of the money, except for now that asset is generating income in the way of interest. So, as a CEO of your life, you must always remember that for each of your liabilities or debts, you are someone else's assets. That is the real two sets of book accounting. For every liability, such as a mortgage, a car loan, school loan, and credit card, you are an employee of the people lending you the money. You are an employee of the people lending the money. You're working hard to make someone else rich. And I'll just throw in a little thing. And one of the beautiful things about real estate, they have the saying, talking about leverage, and J. Paul Getty's famous saying, I'd rather have 1% of the effort of 100 people than to have 100% of myself. And since most people's housing payments is about a third of their income, when you have a tenant, you have a tenant who's giving you 30% of their efforts. And how many 30% does it take to surpass your 100%? And I'll tell you that it doesn't take a whole lot. So next subsection, good debt and bad debt. Rich dad often cautioned me about good debt and bad debt. He would often say, every time you owe someone money, you become an employee of their money. If you take out a 30-year loan, you've become a 30-year employee, and they do not give you a gold watch when the debt is retired. By the way, when we stopped for our comments, there was a big news headline this week about Donald Trump mentioning a 50-year mortgage. And it stirred up a storm of debate. And maybe we'll talk about that in our next break, but I don't want to interrupt the flow of the book. So back next paragraph, Rich Dad did borrow money, but he did his best to not become the person who paid for his loans. He would explain to Mike and me that good debt was debt someone else paid for you. Bad debt was debt that you paid for with your own sweat and blood. That is why he loved rental properties. He encouraged me to buy rental real estate because the bank gives you the loan, but your tenant pays for it. Income and expense. Not only do the two sets of books apply to assets and liabilities, but they also apply to income and expenses. The more complete verbal lesson from my rich dad was this: for most every liability, there must be an asset, but they don't appear on the same set of financial statements. For every expense, there must also be income, and again, they do not appear on the same set of financial statements. This simple drawing will make that lesson clearer. On the left side, the payee, right? That's an expense. The payor, and by the way, one way to remember, there's a little thing that I was taught, I always get the E and the or confused. The E is the person who receives the benefit, right? The payor is the one that gives the benefit. In this case, a mortgage, the payor gave, so the mortgagor is the bank. The mortgagee is the person who pays the mortgage or, because they received. So the E is received and the or is the giveor, and the receivee, just as a little crutch there. So the simple draw makes this lesson clear. Let's talk about the financial fast track and the rat race. And this is referring to the game. The concept of two sets of books, can be used to show you that financial fast track and the rat race. There are many different types of financial fast tracks. The diagram below is one of the most common. It is the track between a creditor and a debtor. It is simplified, but if you take time to study it, your mind will begin to see what most people's eyes do not. You will see the relationship between the rich and the poor, the haves and the have-nots, the borrowers and the lenders, those who create jobs and those who look for jobs. A debtor's financial statement. The income statement, they have a job, the income comes in, they spend all their expenses and pay for their liabilities. Nothing's left over. Then what they pay on their liabilities goes to the creditor's financial statement as their income, and they pay their expenses. But because they have more income than expenses, and in this case, no liabilities, that extra money goes into the assets, which then in turn they go and lend them out and create more liabilities on someone else's balance sheet. And you see, if you study that, the creditors, the circle goes around from the income coming in, pay their expenses, becomes more assets, the surplus, and then they lend it out over and over and over again. And that's what the banks are doing. And so this is a very interesting, it's amazingly simplified, and I think that's why his book was so popular. So the creditor will often say, because of your good credit, we'd like to offer you a bill consolidation loan. In other words, I want more of your bills if you're a good payer. Or would you like to open a line of credit just in case you need some extra money in the future? And you know what happens when you have cash in your wallet, it disappears. Do you know the difference? The path of money flowing between the two sets of books is what Rich Dad called a financial fast track and the financial rat race. For one to exist, so must the other. And by the way, who's in the rat race? Left side. Who's in the fast track? The right side. So the question is, which statement is yours and which statement do you want to have? This is why Rich Dad constantly told me making more money will not solve your problems if cash flow management is the problem. The people who understand the power of financial numbers have power over those who do not. That is why step 2 to finding your own financial fast track is take control of your cash flow. You need to sit down and map out a plan to get control of your spending and minimize your debt and liabilities. Live within your means before you start to expand your means. So here's the take action steps. Number 1, review your financial statements from step 1. Just a quick show of hands. How many people right now have out of the 15 people here, let's put it in the comments, a 1 if you have a written financial statement, and a 2 if you don't. Okay, I'm not going to ask you to show it, but on the honor system, I would love to see, and we should have 15 comments in the chat, right? Okay, well, thank you for being very honest. And P.S., remember, you still were congratulated at the beginning of this, because the fact that you know this already makes you smarter than the average bear. But what really brings the results is, well, see, we have a leader who has a 1. He has a written financial statement. And this is where the rubber hits the road. So in reality, if this were a course, you can't move on and complete chapter 2 when chapter 1 hasn't been completed. So if you haven't, and I don't know if Jameson, if you still have that link to the PDF of that form, but you know what? I might even create one between now and our next reading. Let me write it down so I don't forget it. But I'm going to recreate that in a Word or PDF document that we can share next week. So those of you who show up next week, I'm going to have the personal financial statement in PDF for you to fill out. But don't wait for me. Don't wait for me. Start filling yours out. And it's really very easy, right? It's what are all your incomes minus your expenses? That's your income statement. What is everything that you owe and own, and everything that you owe? That's your balance sheet. So number 2, determine which quadrant of the cash flow quadrant you receive your income from today. That's kind of like what I was talking about in the 3 columns of income that I now track. So in reality, the left side of the quadrant is really all one, whether you're an employee W-2, whether you are a employee W-2 on a salary or on hourly wage, or whether you're self-employed. Okay, and that means the team of 1, whether you're self-employed or whether you are commission-based, it's basically the same thing. So the whole left side is active income. The right side, the 2 other boxes are, do you have a business, a system that generates income? And then do you have investments, i.e., stocks, bonds, precious metals, real estate, and whatever that generates income. Okay, there's assets that you buy, artwork, wines, and things like that don't generate income. One of the fascinating things is that I never knew until maybe a month or 2 ago that you could own precious metals and receive income. We can talk a little bit more about that later on, but determine which quadrant of the cash flow quadrant you receive your income from. And remember, the name of the game is how much money is coming from the left side of the cash flow quadrants versus the right side. Number 3, determine which quadrant you want to receive the bulk of your income from in 5 years. Now, as you know, I've got the 5-year career, and this is a new coaching program that we started, which is taking whatever career you're in and then getting very clear on these things so that we generate enough income in the passive income column that they can take the foot off the gas pedal. I'm not telling them to retire in 5 years. That's a personal choice. For example, me personally, and I know a lot of entrepreneurs that when they hit that point where they could retire, they don't, because they love what they do. And so if you're doing something that you love, but it's for the people who are grinding and dreading every single day, then when you reach that passive income mark, think about all of the options now that you have. You could do nothing, but most people get restless, and that's no good. You could do more of what you do, but at a higher level and with more pleasure. I always say I'd still, help people get homes. I would just not work with the people who are unpleasant. I would just say, thank you. Have a nice day. These are the options. Or you can do something completely different. Go pursue your passion. Go do missionary work. Go do whatever it is that really lights your fire, because that's what life is really all about. So determine which quadrant you want to receive your income from in 5 years. And P.S., if anybody ever wants to talk about this, I'm happy to discuss this with you. And, we talked about earlier that it's really all about clarity. I'm going to tell you, there ain't a skill. Last night we had a little gathering at my house with a bunch of friends, and, over wine, people get very philosophical. And we were talking about, exactly this topic, which is kind of interesting. And what people would do with their time if they didn't have to spend so much time at the office or working and so forth. So number 4, begin your cash flow management plan. Okay. And this, by the way, the important thing here, notice this is half the words in this sentence are action verbs. Begin, management, plan. In fact, most of the words, flow. These are all things that this is not something, the cash flow management is not passive. You can later automate it, but it's not, you have to, A, pay yourself first. Put aside a set percentage from each paycheck or each payment you receive from other sources. Deposit that money into an investment savings account. Once your money goes into that account, capital never, take it out until you're ready to invest it. Congratulations, you've just started managing your cash flow. And by the way, there's a great book by Mike Michalowicz called Profit First. And it's exactly about this step A. The book is all about explaining why, and by the way, also explaining why the fact that most people don't do this is why they end up in the 80% dependent on Social Security, because they pay all their expenses first and they get to keep what's left over. Now, in the beginning, in that book, called Profit First, he talks about you've got to, you don't know what your profit is, just do 1%. So take 1% of everything that you earn and automatically put it into an account that you don't touch. It's gone for all use and intents. It's gone, but it's there when it comes time to say, okay, what do I have to invest? And in the beginning, it will be small. But what we're talking about is the habit. And by the way, remind me before we end to talk a little bit about the 21-day system that we developed. So congratulations, you've just started managing your cash flow. Pay yourself first. Write that down. Put that on a sticky in the mirror. Pay yourself first. Take the discipline, because think about this. When you get a paycheck, the government automatically takes their, FICA, FUTA, their federal income tax comes right off the top, which is why I was saying before, the person who says I make $10,000 a month, but $7,000 hits the bank account. The other 3,000, they never got to see, touch, or direct. So what do they really make? Their take-home pay is $7,000, but in their mind, they walk around and spend as if they were a $100,000 earner. Now, if you were to take that first 7,000, 1%, $70, not a lot for a month when a person makes $77,000, but it's 100% more than the people who don't pay themselves first. So B, focus on reducing your personal debt. And Jameson, thank you for putting the link to Profit First book. I'm telling you, that's a very worthwhile book to have in your library. Focus on reducing your personal consumer debt. This is the debt. Remember the good debt and bad debt. Good debt is what someone else pays for. Bad debt is what you pay for. And the following are some of the simple tips for reducing and eliminating personal debt. A saying that I frequently repeat also on the show is debt is the middleman between you and financial freedom. Tip number 1, if you have credit cards with outstanding balances, discipline yourself to use only 1 or 2 credit cards. Any new charges must be paid off in full every month. Do not incur any more long-term debt. Remember, we're talking about consumer debt. Do not incur any more long-term debt. Hard to do. It's discipline. Tip number 2, come up with $150 to $200 extra per month. Now, this is voodoo. Now that you are becoming more and more financially literate, this should be relatively easy to do. If you cannot generate an additional $150 to $200 per month, then your chances for financial freedom may only be a pipe dream. Well, there's a punch to the ribs. And by the way, for those of you in the reading club, if you hang out after the reading club, we're going to talk about some of the things on how to do exactly these things. And with as little as $50 a month, you can start generating a substantial income, a substantial ROI. Tip number 3, apply the additional $150 to $200 to your monthly payment of only one of your credit cards. You will now pay the minimum that you always pay on your credit cards, plus the $150 to $200 on that one credit card. Pay only the minimum amount due on all other credit cards. Often people try to pay a little extra each month on all of their cards, but those cards surprisingly never get paid off. That's why you want to focus. One card, knock it out, close it. Not close it, put it away, but don't close it. Tip number 4, once the first card is paid off, apply the total amount you're paying each month on that card to your next card. You're now paying the minimum due on the second card, plus the total monthly payment you are paying on the first card. Continue this process. This is what they call, by the way, the snowball method. Dave Ramsey talks about that. Susie Orman talks about that. It's been around for a while. It's no mystery, just people don't do it. Continue this process with all your credit cards and other consumer debt. With each debt you pay off, apply the full amount you are paying on that debt to the minimum payment of your next debt. As you pay off each debt, the monthly income you are paying on the next debt will escalate, the snowball. And P.S., there's a conversation, right? There's the avalanche method, which is paying the highest interest rates first. There's the snowball method, which is what he just described. And there's other ones, okay? They're all, which one is the best? Actually, neither of them, okay? But those are easy to follow, and a plan is better than no plan. And so which plan is better? There's something that we designed for our investors, which is called the highest cost per thousand. It has nothing to do with the interest rates, because some credit cards, they simply have a higher minimum payment, even though the interest rate may be lower or higher. It's what it costs you cash flow wise per month. And so we have a program. If anybody needs help with this, let me know. But what we plug in the numbers into the program, and then it tells us which is the first credit card, which would be the most efficient to pay. And by the way, I don't care whether it's a credit card, car loan, we put it all into that formula, and then we pay it off in the order in which it's supposed to do. In fact, there's software available out there that you put the information in there, and then it automatically tells you which credit card to pay. And it'll even tell you that if you continue to do this, exactly when you'll pay this off. Again, clarity. Tip number 5. Once all of your credit cards and other consumer debt is paid off, continue this procedure with your car and house payments. If you follow this procedure, you will be amazed at the shortened amount of time it takes for you to be completely debt-free. Most people can be debt-free within 5 to 7 years. Think about that. Not 30, not 50, 5 to 7 years if you had clarity and commitment and coaching. Now that you're completely debt-free, this is tip number 6. Take the monthly amount you were paying on your last debt and put that money, which now is accumulated, because remember all of the different cards you had, towards your investments. Build your asset column. That's exactly how simple it is. Side note, Kim and I explained this process of reducing and eliminating debt, your bad debt, in our audio program, How We Got Out of Debt. So that takes us to the bottom of 245 and the end of chapter 12. Any comments out there? I would love to hear any comments, feedback, ahas, and or questions. Pulling down my list of everybody who's here, taking attendance, noting your files.
Jameson's got his hand up.
Okay, good. For some reason, I don't see that, but thank you, Jameson. Go ahead. Now I see it.
Good morning, Eric. I love how you went over the personal financial statement, broke it down, related it to everyday life. You know, one of the clearest examples of people that would, when they think they had it all down, when COVID hit, it became a reality. And if they took the financial COVID I'm talking about, when everything shut down and you were relying upon your passive income because your active income just went away. If you didn't have a passive income, you kind of got retired there for about what, a year? Everyone was, or 2 years. You were retired for 2 years, forcefully retired. You got furloughed, you got laid off, and then your passive income got negatively. It started getting hit because if your tenants move out, who's paying the rent?
Yep.
So
And
yeah.
You're 100% correct. And by the way, how about the 40 days of the government shutdown? All of those people who all of a sudden their safe and cushy government jobs were suddenly had a big question mark hanging over them. And as time went by, an even bigger question mark. So that's why that focus. Okay. Now, like I said, I'm not even saying for people that they need to retire in 5 years, but what if you could get this part of life's equations solved in 5 years? Would that change your life going forward?
Yes.
Indeed. Indeed. Good morning, Ron. How are you? Thank you, Jameson.
Doing good. Doing good. I when I look at the balance sheet or whatever it was called, I forgot all of a sudden. When I look at that, there's good to it, which says, "Wow, I'm in the negative. I'm going the wrong way," and that's a wake up. For me, the word awareness is incredibly important because when you're not aware of where you stand, you have no idea which way to go and if that's a good way that you're heading. But it also once you get it to the positive side where your passive is increasing, now you feel really good about, wow, I'm doing something good. Let me keep doing more. And what is it that I am doing that's doing it, which was the end part of this chapter. So I really like going in on a monthly basis. Thank you. That's what you said. On a monthly basis, doing that net worth program there.
Yeah, yeah, and you know, that's another sort of aha that I would call recently. That is it's a duh turned into an aha,
Yeah.
which hopefully is then turned into, good results. But the duh is clarity. Okay,
Mm-hmm.
you got to be clear about what outcome you're looking for, right? You got to be clear, because if you don't, there's a million different distractions. There's a million different things you can do every day. And it's very easy to stay busy.
Mm-hmm.
It's less easy to be productive,
Yeah.
right? Like I had a busy day. And so in your mind, it's very important to have little measurements. Like today, I used to have days where like I worked my tail off. And at the end of the day, I go like, man, I've been so freaking busy all day and I got nothing done.
Mm-hmm.
I feel like it was an empty waste of energy. Then there's days that just flow. Just it was like it was the easiest day. I flowed from one thing to the next thing to the next thing. And at the end of the day, I go like, wow, I got a lot done today with not even a half of the effort. And then I started saying to myself, how do I know I had a good day? Right. And that's where you want to have what they call KPIs, or whether they call them goals or whatever, to-dos. If you have certain things that you want to accomplish every single day, there's a routine things. Get up in the morning, brush your teeth, comb your hair, get dressed, your personal care. You got to do them anyway, right? So they're on a checklist. Then after that, you come down, you make coffee, get the house ready, get everything going, and stuff. Check, check, check. And then you have, what do I want to accomplish today? What's the main thing? Jameson, a few sessions ago, there was a statement that he made, or maybe it was you, Ron, that said that, what's the one thing? What's the
That
one
was me.
thing? Yeah, that was you.
Mm-hmm.
And so I wrote that down, and I look at that. So what's the one thing that I need to do today? And sometimes I'm good at it, and I do that one thing. Some days I did everything but.
Mm-hmm. Yep. I took a course many years ago by David Allen, Getting Things Done. His book's out there. It's still worth reading, quite a bit, I might add. But we for an hour and a half in that course, we wrote down everything we wanted to do and everything we wanted to get accomplished. Then we went back through it and we crossed off till we got down to 100 of things we wanted to do. Then we'd spend some more time crossing off down to 50 and then 20. And then we got to about 20, and his comment was, now pick the first 6 that you wanted it done that's important to you, because we rated them as important. And he said, if you just do those 6, everything else is going to go away. So your big list of confusion as to which to do first is going to be narrowed down to about 3 in general. Because once you've done them, the rest will probably fall off and you find out you didn't need to do that, which is part of
100%.
it. Yeah.
Any other comments? That is so true. That is absolutely so true.
Mhm. Well, I do have another comment, and then if you can't see it, Fernando has his hand up. But the other comment is that your statement: are you completely comfortable with your that your retirement is taken care of?
Yep.
And which again goes back to your clarity. Am I really going in the right direction? And for me
Yep.
right now, no, I'm not comfortable with that retirement, even though I am, so to speak. I still work. But thank you for adding that to my major questions to review on a regular basis.
So I have, and laugh if you want to. I do this, some things I do very archaically, as
Mhm.
technologically advanced as I try to be. I also, there's certain things that it's neat to be able to touch and move around. So I have these 3x5 cards when there are things that I want to keep constantly in front of me. And so here it is. How comfortable are you with your retirement plan? Are you comfortable that your retirement is all set and taken care of? Or do you have concerns?
Yep.
Okay. If I
Yep.
were asking you, put it in the chat. Are you comfortable that your retirement is all set and taken care of? Or do you have concerns? Put in the chat, taken care of or concerns, just out of curiosity. So my goal is to go completely paperless by the end of the year, and I've been working on it, but I still write down in, pencil and paper. I write down what I have to do that day, cross them off as I go along. There's a little dopamine um, hit that happens when you check stuff off of the checklist. The name of the game, though, is to have important things on the checklist, to have the right thing. Otherwise, you can have a page full of checks. Like I was
Yep.
saying, man, I was busy and I was knocking those checks off. I opened the mail, I swept the porch, I vacuumed the house. You know, I did all those things, and at the end of the day, man, I made no money. What the heck happened? And so here's one for business, and to kind of bring it back on not just the personal level, but also but they're intertwined. You can't separate the two. But as a mortgage professional, I used to ask myself, how do I know I had a good day? Because some days I had closing, some days I was out in the street, pounding the pavement. And then I started looking at this different measurements, and I said, listen, whenever I go out on an appointment with the intent to help somebody to get a home, get a mortgage, etc., I would ask myself afterwards, how do I know it was a good appointment? You see, I can't measure it by did I close the deal every time. Okay, because not everybody wants to be closed, and sometimes the timing is wrong. That day they had a fight with their spouse, and they ain't going to do anything today. And it doesn't matter how good of a salesperson or how good your product is, you know, it's not just not going to happen. So how do I make sure that every one of my appointments results in a positive outcome that moves the needle somehow forward? And I said, listen, if I can leave that property with a sale, that's an obvious win. But if I can leave that appointment with 3 referrals, that's also a win. Because think about this for 1 second. If every time I talk to one person, I got 3 more names, okay? Then I now call those 3 and get 3 more names. So 1 becomes 3, becomes 9, and you will never, ever, when people tell me, and obviously I've been in the sales business for a while, when people tell me I don't have any prospects, I don't know where they are, I said, listen, all you have to do is get 3 names from the next person you talk to. And if you continue to do that every time, you will never, ever, ever, ever run out of people to talk to. So that's the thing about measuring and being productive. On the cash flow thing, if you're not measuring your cash flow, if you're not looking at it, Ron, you said it the best. It's awareness. Call it your monthly awareness statement, that in a 1-page sheet, you can just lay it flat down on your desk and look at it, and it will tell you the truth, black and white. The numbers don't lie. So, any other comments?
Just before, Fernando still has his hand up, but I got a
Oh,
comment on that.
okay, yeah, I got to make that screen bigger for me. Thank you.
It's going back to the awareness part. There was another course, I've forgotten exactly where it came from, but it's your awareness is oftentimes caused by asking a better question. In other words, it's the questions that you ask that bring awareness to your life. So he used to say, well, if it's not going the way you want it, just ask a better question in your life.
That's 100% true. In fact, Tony Robbins used to say that all the time. The quality of your life is a reflection of the quality of the questions that you ask.
There you
And then
go.
the follow-up of that is, and get answered, and solving that issue.
Mhm.
Fernando,
Good morning. Happy Saturday. I'm
happy
going over
Saturday,
my notes.
brother.
Hey, great to hear from you, Eric, and everyone. I appreciate this information. I take a lot of notes, but there's one thing that I learned a while back, and it's a saying that I always used to hear from one of my mentors is it's not how much money you make, it's what you do with what you make, and how much of that are you keeping. So that's one thing that I've learned. But through going through the reading today, I kept thinking about what you read earlier. Your debt becomes your employer.
Yeah.
And the thing about that is that most of us think that, see, we think about owning a property, but we don't think about how long it's going to take to pay it. So if we got a 30-year mortgage, that's a long time to pay, right? So the bank is employing you to pay them a 30-year mortgage. And the thing about it is we got to learn to understand how we can compress it and pay it a lot sooner, or maybe borrow against it, purchase another property, rent it out, and have someone else pay it for you. Makes sense, or at least half of it. So the things that I'd like to learn about what we're talking about today is understanding time. See, our activities also, Eric, as you alluded to, can be an asset creating activity or a liability creating activity. If you're in sales and you're not working your list of contacts, you're not doing the work. See, assets
Mm.
in time frame in regards to your efforts is if, like you said, Eric, if my appointment cancels or the appointment didn't go through the way I expected it to, I didn't end up closing, I got to ask for referrals. Other than that, it was a waste of time. So I really appreciate this. So I'm taking a lot with me. Uh, if you take out a loan, you become a 30-year employee. I made a note of that. They do not give you a gold watch. Whoa. So thanks again. Great stuff. Appreciate you.
Yeah, great stuff. Anyone else? Because if you think about this step two is really critical. And you remember the saying, and I'm going to go back to it. If more money will not solve the problem if cash flow management is the problem.
That was a big
Yep.
one for me.
I agree on
Yeah,
that one too.
trying to see where that was.
While you're pulling
But
that to find two cash flow things, I went on richdad.com, went under resources, and found an actual spreadsheet, an Excel spreadsheet, and I included that in the chat. And then I found the original one-page PDF that you have to print out and fill out, or use as a guideline. And I put both of those in the chat. And if Fernando, if you want to put those up on your website, either one of those for later on, because you're not going to be able to see the links in the chat, on the recording, that might be useful.
Yeah.
Gotcha. Will do. Thank you so much, Jameson.
And they came off of richdad.com, and there's many other resources in there too. For education, there's a cash flow course. Just saying, if you want to further your education in this brand or Robert Kiyosaki's Rich Dad brand, there is also those opportunities there too, and the cash flow game on top of that.
yeah, I just opened both. And so it looks like they have a little bit of a modification, an upgrade. Do you guys see it on the screen?
Yes.
Yes.
The PDF file? So you
Yes, we
see
do,
where,
Eric.
pardon me?
Yes, we see it.
Okay, cool. Thank you. So you can fill it out, with quote unquote the deck of cards that you've been handed. And here I see the addition, whatever your profession is, put it there. What is the dream? Why are we even working? The reason that we working, you were not born to go do your job unless your job is part of your dream. Then it kind of walks you through these step by step. And again, it's one page, it's in the chat, double click on it. That's the PDF version. I also downloaded the Excel. I'm going to play with that, and so we'll have an automated version of that as well. Any other questions, comments, ahas, or statements? Because we're coming up at the bottom of the hour. I'm not going to start a new chapter, although I will tell you that so we just finished step 2, right? I'm not sure. Well, I'm going to take a little peek ahead, but so we have steps 3, 4, 5, 6, and 7, and a summary. So this book may take us through the Thanksgiving holiday, and maybe up until and I'm sure we're not going to have a reading club on the Saturday of Thanksgiving, but we may finish the year. And what a great way to finish the year is having all these insights and the resources to set up to make 2026 the best year ever.
Yeah,
Anybody's thoughts on that?
like it.
Cool.
Sounds pretty exciting.
It is. And again, it's all in your hands, believe it or not. Because the steps that we've talked about, there's nothing that we have talked about in the action steps that is beyond the capability of anybody on this call. Nothing.
One of the things that Robert Kiyosaki said, I can't remember which book it was exactly, but he said one of the best things anyone can do, even if you have a minimum wage job, anything, is to have a bookkeeper. And a bookkeeper can organize all this information and keep it up to date for you. And it's one of the most valuable team members you'll have, because they'll keep you straight.
Yeah, yeah, and just watch what happens, because AI is already in the accounting business.
Oh,
And
yeah.
I've noticed, I use something called QuickBooks, and there's Quicken for people's personal, the easy one for people who don't have a financial background. But you can literally today, you get the program, you link it to your bank accounts, and then it automatically updates and downloads all the information. So there's no manual typing at all. And then all you have to do is to go through once a month and reconcile the bank statement to the Quicken account, which is pretty, it takes about 10 minutes. And now you can print out any financial statement, your income statement, your balance sheet, and it is up to the moment. So to your point, Jameson, today, and there's lots of apps that are on your phone that are just as good. I think Mint is one. There's a number of them. Some of them have a small charge, but think about this. You could pay a bookkeeper $10, $15 an hour to do this work, and I'll guarantee you that they'll charge you a few hours a month. So it'll cost you 50 to $100 a month. Or you can pay $10 a month for one of these software programs and have it fingertip ready all the time. And that's a really cool thing. The Hurdler app is one of the apps that was introduced that I still use today. And I always get reminded because it says it tracks my mileage as well in real time. Gone are the days where I used to have to keep a mileage log in my car and write down every time I drove for a business purpose and then add it up at the end of the year. Now it's all done. Now I go to one meeting afterwards. It says that there's a $29.61 write-off, and it's keeping track all along. All I have to do is say business or personal, business or personal. And at the end of the year, I've got thousands of dollars of write-offs just from that one program. And today I pay, I think, I don't know if it's $100 a year, less than $10 a month for that app, that I don't give it up. And there's a free version which has a limited number of things, but because of the number of transactions, I needed to upgrade it. But if I save thousands by paying 100, was that a good deal?
Yeah, baby.
Yeah, baby. Any other comments before we wrap it up?
I have a question.
Yes, sir.
You had made a mention that you talk about highest minimum something. Can you go back to that comment?
Sure. That's called the highest cost per thousand.
Highest cost.
What I found out, and it's very simple to do, Ron. You can even do it if you're handy with a spreadsheet. Take a spreadsheet and then list all of your debts on that sheet. And you can do this manually too. It's just easier in Excel, or Sheets if you use Google. And then you list all of your debts. Just for my knowledge, I'll usually list what the interest rate is in the next column. And then the two most important things. Number one is the monthly payment. And then number two is the balance. And then I have the only formula that I really need is I divide the monthly payment, the minimum monthly payment, divided by the balance. So how much do I pay each month divided by how much I owe? And it's going to give me a number which I take out to 4 decimal points. Okay. And basically it's going to be 0.01. If it has 0.1, you're getting raped in the interest rate department. But 0.01 is 1%. So most credit cards these days charge somewhere around 1% to 2% of the balance as the minimum payment, so that it does amortize. A shocking fact that a lot of people don't know, that if you only paid, and by the way, this is the trap, if you only paid the minimum payment on a credit card, that credit card will take not less than 10 years, and in some cases, the same amount as your mortgage, 30 years.
Oh, yeah.
So paying the minimum on your credit card is basically like being IV on heroin.
Yep.
So the highest cost per thousand tells me, so then when you have that column of the 4-digit decimal point, the payment divided by the balance, focus on the highest value, because that's what you're getting rid of the most. That's the most efficient payment. And I used to do that for all of my mortgage clients. And the cool thing about that is it really helped a lot of people, reduce and minimize their debt. The only problem with that is that if you don't know how to do a spreadsheet, then the minute something changes in your life, your income goes up or down, your expenses go up or down, then it alters it would alter the spreadsheet, and it could change the results. It's easy for you and I to update, but not everybody.
Right. Just while we're on credit cards for the moment, it's really a good thing to go back and audit and all your credit card list of charges. You'll find that things you've signed up for, you're paying for years after you didn't think you were. I paid one time 8 years of Bell South phone charges, didn't know I was paying. And that was a lot of money. And we had a long time argument on that with the company, but they finally paid me the 8 years of charges that they did.
Yeah. No,
but you don't know until you audit yourself.
It's our personal responsibility. And that's why when I was saying about you can download everything, by the way, including credit cards. So I set it up, and every time I log into my program, it tells me how many hours ago it's been since it updated. But then when you go through the reconciliation, which, like I said, takes 5-10 minutes, but you'll spot, because if it's something that was not on there, you'll notice that, in other words, so any errors or, erroneous charges, but now you're looking at what are your regular expenses, and then you can go, by each category, If you categorize, all of your expenses, restaurants and food. So I know that I spend an average amount per month of that. Well, but all of my regular dues and subscriptions are also I can make it print out by vendor, and all of a sudden you go like, well, who's this? Or man, I don't use that anymore. It's nothing, right? 19.95 a month. That's $20.
Yeah.
A lot of us won't feel that. We'll waste that at lunch, right? However, $20 a month times 12 is $250. And that's real money. And do that 4 times, that's $1,000 a year that you just basically, flush down the toilet. So, hey, any other comments or questions? That's a good point, and that's why keeping track and having your monthly awareness statement, your personal financial statement. Remember, if you're not preparing it, somebody else is for you, and that's why you get credit card offers. You've been pre-approved because according to us, your financial statement probably looks like this, and you could afford to pay us some interest every month.
Mm-hmm.
So if there's no other comments, and by the way, first of all, I want to thank everybody who came and participated. The participation is really what makes these calls even more interesting. But I just wanted to talk for a second about the 50-year mortgage. And a 40-year mortgage already exists, just so you know. And it was widely used during the real estate bubble as a way to make payments affordable to keep people in their homes. People were doing modifications where all the payments that they didn't pay, and this is always funny because the statement I would hear is they took the amount that I owed and put it on the back. There's no such thing as putting it on the back. They put it in to the pile that you already owed. So now they're going to make interest on the interest that you didn't pay before. And then what they would do is that in order to make it affordable, they would stretch it out and amortize it over 40 years. So the 40 years, even though it's not commonly talked about and well known, already exists. The 50-year mortgage, and so here's what's interesting, is the responses that I got were largely along political lines. Okay, not financial, political lines. The people that align with the current president said, oh, this is a good idea. We're going to make housing affordable again. The people who are not with the president said, oh, this is absurd. All this is going to make the banks more money. Well, if the banks don't lend you something, many people won't have home ownership. And I believe home ownership is the more important factor. Number one. Number two is that even though the amortization is slower, the pay down of the mortgage is slower, and therefore the equity from pay down of the mortgage is slower, you're still in the marketplace and you get the appreciation. You see, the alternative to the 50-year mortgage is renting, and that's the 1,000-year mortgage with no tax benefits and everything. So while I would say if you can get the 15, get the 30, get the mortgage that you can, because it's more important to get the mortgage that you can than to not have the house that you can't. That's my editorial opinion. Any thoughts?
Yeah, add to that fixed rate.
Yep. And by the way, think about that advantage. You say so if you look at it from a financial point of view, it's a great option to have on the table. Yes, it's great for the banks, and the banks will make way more money. On a 30-year mortgage, the bank makes about 2 to 3 times what they lend. They lend $100,000 mortgage, they're going to get paid, $200,000 to $300,000 back. So one person could argue that you're buying your house and the bank 2 more houses. But that ignores the fact that you got home ownership and all the even non-financial advantages, lower divorce rates, stability, lower teenage pregnancy, lower drug use, higher success rate in grade school, middle school, high school, and college, higher performance in their careers. All of that has been studied and documented by the best universities in the world. Yet most people will look at, what is the bank making off of me instead of what I'm making by being a homeowner. So any other comments, pro or con? This, I didn't give you the exact right answer because there is no right answer. It depends on each person's goal, the desired outcome, and their capacity.
If you can see, Gerald Parker has his hand up.
Dr. Parker.
Great morning, Eric. Great read. Great information also. But I want to talk about that 50-year mortgage. I'm hearing things kind of stir around in the market that it's coming. Pro or con right now, I don't know, but I guess it depends on the individual's circumstances or situation, right? I can see where it may benefit some, particularly if you're strapped for cash, your income situation has changed, you need to extend it out over time. But in that process, you'll get them a lower monthly payment, which is good. But the goal should be, again, for all of us, and that's why we're here, to position ourselves where we don't even have to consider that as an option, right? So, but that's why I'm saying it's so important that we really get our financial life in order.
Yeah, 100%. And the one word that really stuck out in your comments is the option, right? No one's telling you that from now on, you have to go get a 50-year mortgage. We're just putting it on the table. And if it makes sense, and watch this, for a lot of people that can't qualify for a 30-year mortgage, but can qualify for a 50-year mortgage, is a 50-year mortgage good?
Absolutely.
Absolutely, right? How about for the investor? If my goal as an investor right now is to create cash flow, appreciation down the road is good, but cash flow, what do you think an investor is going to look at and says, listen, I know I'm building equity much slower, but my problem or my need today is cash flow. That's a great mortgage for an investor that wants cash flow. So, and PS, when the extra cash flow, at my discretion, at my option, I can put principal payments. I can buy more cash flowing properties. So, but I think before people draw a conclusion, I think the most important thing is that I think it's a good thing to have the option. No one is obligating anybody to take it. No more. And by the way, what is the amortization period for an interest-only loan? Nobody criticizes the interest-only loan.
Oh, right.
Another concept on the loans, and we're going to put it in the 15-year loan versus the 30-year loan, so it's easy to hear, is that at any point, if you get a 15-year loan or 50, if you get a 15-year loan, then the payments are going to be higher. There's always glitches in your life, financial glitches that come about. And if you've got a higher payment on your mortgage and you start having to miss them because of the glitch and the high payment, then you go into foreclosure. But if you took that 30-year or 50-year loan, now you have that cushion where, okay, I can still make this payment. But then at any point in time, you can always pay down the longer loan and pay it off quicker. In fact, MWR basically works with that to help you pay it off. So I'm game on the 50-year loan. Just learn to pay it down if you can, when you can.
Yeah.
And people get these cars and they pay $700 for a car. If you keep it and don't get another one quickly, then that $600 payment can go to pay down many years of your mortgage. Just pay it to that. Does that make sense? Did I say that right?
Absolutely. Yeah.
Okay.
Yeah. And the important thing is giving people options. Okay.
Yes.
And then the next most important thing is make sure that there's ethical loan officers out there that will explain the pros and cons of each option and then help them to make the right decision for the client.
Exactly. Which
Well,
goes
Eric,
to
same
asking
thing.
a better question. Learn what questions you need to ask.
Yep.
Same thing goes for auto loans now. There was a time where the maximum auto loan was about 3 years. Now you can get a car finance for 6 years.
Yep.
7. I've seen 7. There's 7-year leases now. Okay. All they're doing is trying to make, larger tickets. And PS, if that 50-year mortgage comes to be, and I believe it will, because the market will want it. What do you think that will do to the real estate market? Think about
Oh, you
supply and
talking?
demand.
Yeah. Well, that's going to help the market, wouldn't it?
Yep, absolutely. And it tells me that the price of real estate is going to go up in 2 ways. The first one is that because more people have access, the demand will go up, right? And as people start looking at real estate as a longer and longer term hold, unless we build more, the supply will go down, which means the prices inevitably will go up.
Yep.
So that's what I got for today. It was a great chapter. We could go on and on with this thing. For those of you who are interested, stay on, because we're going to talk a little bit about a business opportunity, the B quadrant, a little bit.